Good morning, everybody. Hope we're doing really good today. Welcome back to the channel. I made over $1,000 last month, and in this video I'm going to tell you why that has me a little bit worried and what I'm going to do about it. First though, before I do that, if you're new to the channel, I'm Justin. I like to talk about dividend investing, income from options, financial independence, and document my own journey towards financial independence. So, if you're new to the channel, I'd really appreciate it if you subscribed, because my analytics say that 92% of you are not subscribed to the channel. And then give me a little thumbs up for the YouTube algorithm. I'd really appreciate that a lot. Okay, now on to the good stuff. I made $1,005.63 selling options last month. That is selling options on the wheel strategy. And essentially the wheel strategy is you sell puts and then you sell covered calls. If you don't know what those are, a put is like a promise to sell a stock, or a put is like a promise to buy a stock if the shares go down. And you'll get a little bit of money for this promise. And then a covered call is the same thing but in reverse. You make a promise to sell the shares if they go up, and you get a little bit of money for that promise too. And the wheel strategy is you just kind of keep doing this. You sell a put and then it'll either expire worthless and you keep your little money, or it gets assigned. And then when it gets assigned, you sell covered calls against it, and then you get your little money there too. And then it will either expire worthless and you just keep selling covered calls on it, and then or it gets called away, and then you just do it over again and you sell another put, and you sell a put and you get it called away, and then you sell a covered call and it gets called away, and sell a put. And that's why it's called the wheel strategy, is you just keep doing this in a cycle over and over again. Now when I do this, I usually avoid highly volatile stocks. You know, things that you'll see on Wall Street Bets and these meme stocks. I think they're too risky, and I don't really want to play with that. And I look at the wheel as like a safe income strategy. But you can add a lot more risk to it with these highly volatile stocks. Things like GameStop and that kind of stuff. AMC and some of these other ones. I sell a lot of my contracts on things like Pfizer, Intel, Bank of America. These offer higher premium, and you can sell your promise, you can sell your puts and calls for more money compared to other big blue chip companies, but not as much as some of these highly volatile companies that you'll see on Wall Street Bets. But I've kind of been tempted, and I did sell a few contracts on some of these more volatile positions. And I'm on track to make $1,000 again this month. So let's go ahead, let's go into my spreadsheet so you can see what's going on with my puts and my calls, and how much I'm making and why I'm kind of worried about it. Here's my little spreadsheet on how I keep track of all my options. The white ones are things that are just done with, and they're closed out in their history, and I don't worry about them anymore. My blue ones are things that are still open right now, and my red ones are contracts that I closed out this month. And I just keep them red so I can keep track of it at the end of the month, how much money I've made. So as of right now, I've already closed out $815.77 in option contracts. So that's how much money I'm keeping so far. And I have a few others expiring. I have this Kroger that'll be getting called away from me in next week, and a few others that'll expire next week. So we'll see at the end what those tally up, but I think it'll mostly be a profit. And you can see that I have like Snapchat. I closed that out recently for $165. Snapchat here, $91. Neo, $208. And Palantir, $116. And I've been kind of getting tempted into these higher implied volatility companies because they offer a lot more money compared to something like, see this, where are we at? What's a good example? This Walgreens up here. Walgreens made 75 bucks off of a contract there, and that's pretty good. That's not bad, but if you look at like Snapchat, I rolled this, I closed it out, I made 91 bucks, but then within the same month I sold another contract on it for another 124 bucks. So they're offering a lot more money to sell puts and calls against these kind of companies. The one I'm really not happy about is this Workhorse, and I think I just was tempted. It was a lot of premium, and it's not just shooting up. It's not in the money, but it's kind of drifting lower. It's gone from like $39.95 to $37. So I might just buy to close this. It'll break even. I'm not going to make any money off of it, but I'm having the trouble sleeping, and I'm always worried about this position. So I'm just going to close it out, I think. Now, the reason that $1,000 worries me is because my account is about $56,000, and $1,000 a month from $56,000, that's about 21% return. And I think that's a bit unsustainable. And with the way YouTube is going and how many thumbnails you see about this is the next great SPAC, or this is the next great EV company, or this company's going to 4X, this company's going to 5X. I think these are signs of that irrational exuberance at the top of a stock market. So I want to really reduce my risk. And I think 21%, yeah, that's nice money, but I'm afraid that in a big correction, I'll lose all that money, and then, that's no good at all. So the way I want to do this is, I was watching some stuff with Tasty Trade stuff, and Tom Snosnoff was talking about statistically and mathematically the best time to close out a put is at 50% of max profit. So that's what I'm going to do. On my high IV positions like Snapchat, Neo, and Palantir, I'm going to close those out at 50%. Then I'm going to sell my contracts, around 45 days, and then I'm going to close them at 21 days because that's when gamma picks up. And that's when you lose all your money because you have no more, you have so much less time involved in the contract, in the options price. And I'm going to adjust my delta for these, so I'm not going to be selling puts on like 30 delta. I'm going to go to about 25 delta to reduce my risk on things like Neo and Snapchat. Now, I think if there's a correction, it could be pretty fast and can be pretty hard. And if you look at Twitter, Twitter's a really good example. On January 19th, Twitter was trading at $44.50, and today, less than a month later, it's trading at 68 bucks. Twitter is up over 50% in less than a month. So you better believe if Twitter can go up 50% in 1 month, it can go down 50% in 1 month. And that's a lot of risk that I do not want to be involved with. I want to get that risk off the table and mitigate it as much as I can. So I'm still going to be selling puts on, Neo, Palantir, and Snapchat, but I'm not going to wheel these. I'm not going to take them to assignment. I'm going to roll them early or buy to close. So I'm not going to wheel those. I do not want to wheel something that can go down like 50% in a month. That's, you'll be wheeling that for a long time before you get back to even. So that's my update on what I'm doing with my options portfolio. Go ahead, leave a comment down below what you think about it. If you've watched the video to this far, I'd really appreciate a thumbs up. Subscribe to the channel if you haven't. And then I'll put some other videos somewhere that you can watch. And then I want you to go have a good day, all right? Justin out.